History says that when you reach this level of craziness, the market tends to break within a few months rather than a few years. And this has been exactly how the great bubbles have broken. The blue chips, the S&P 500, have kept strong right up to the last second, and wave after wave of the stocks that had made the real running peel off and drop. In 1929, the flakes were down for the year before the market broke. They were down 30%. The year before, they'd been up 85. They had crushed the market. The really classic example of this is the Russell 2000, which is stock number 1001 to 3000. They're multi-billion-dollar companies. They're a serious enterprise. In the last year, they are down. They have not made any money at all. The S&P's made 23%. The Russell 2000 is meant to go up about 1.2 times the market. In a bull market like there was, it should have been up about 30%. It wasn't even up recently. This is a huge divergence of a kind that has never happened other than the super bubbles of 1929 and 2000. Super bubbles can really wipe you out like 1929 did. And that's where we are now. We entered a few months ago into 3 sigma territory, super bubble territory. And the other great risk is last year we also entered bubbles in real estate. This is a very dangerous year that we've just had. Most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the NASDAQ came down 82%, which was fairly brutal. Amazon came down 92%. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect, even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining to that level. I think the crazy behavior, the peak of crazy behavior is behind us. I think we're now in the buy the dip mode, which the super bubbles specialize in. You don't have 2 years of buying frenzy dying overnight, typically. So even in 1929, you had some magnificent rallies. And buy the dip is the watchword of practically every brokerage house out there. And it always is. You never, almost never, have a major brokerage house say, the game's over. It doesn't happen. The commercial imperative is overwhelming to stay bullish. It's how you make money. You know, if you could set your dial for 50 years and throw the key away, that might make some sense. But let me remind you that in 1929, you didn't get back in real terms until about 1954. That's a long wait. In 2000, you didn't get back for 13 years. By modern standards, that's a pretty long wait. And in Japan, which is really the granddaddy of both bubbles, land, and stocks, they are not back to their 1989 peak today. That is a very, very long wait. So if you think you can stand it for 10 or 20 or even 30 years, be my guest. But history says a lot of you will not stand it. A lot of you will become more conservative deep into this kind of correction. If you got out when I said get out, you will be glad. It doesn't mean you won't suffer in the meantime, but at some future date, you will be glad. That worked in Japan. We were very early. But if you'd gotten out when we got out, and you'd suffered as the Japanese market went up, you would still have made and saved a lot of money on the round trip. The same in 2000. We were basically recommending that you ease up on US equities by mid-98. And that was a hell of a rally, and that was brutally painful. But it was still a level where you made tons of money. By 2002, the market was much lower than that. Some bubbles are very specialized to US growth stocks, like 2000. And they hurt. There is a wealth effect. People lose money, they pull back on their spending. But they don't hurt anywhere near as much as when you combine that with a housing bubble. So in 2008, where we had the only housing bubble in American history, that burst and the stock market came down 50% in sympathy, then you're talking serious damage to the economy through the income effect. Because this time we have, as a multiple of family income, US housing suddenly is more overpriced than it was ever in the housing bubble of 2006 to 2008. And they got there this last year since we last spoke. The biggest increase, 20%, that the US housing market index has ever had has taken it to a new high. And they are, in the US, still much cheaper than Canada, Australia, New Zealand, London, Paris, etc. So that is a global event that could cause enormous pain. I haven't written about inflation for 20 years. When I did quarterly letters, I never featured inflation. I didn't think it was on the radar screen. It is now on the radar screen once again. It's not that inflation will go roaring back to 1972 or 1982. It's that it will always be part of the discussion from now on, in my opinion. Instead of forgetting about it, it will be spiking and irritating and falling back and then spiking again. It will be part of the scenery in the way it used to be in the second half of the 20th century. There's a lot about this economy, I think, that will be dragged back into the late 20th century. We've had a very, very abnormal honeymoon Goldilocks period for 20 years, which I think is ending. Let me put it this way. We're in the early stages of running out of raw materials. We live on a finite planet. There's only a certain amount of cheap oil, cheap nickel, cheap copper, and we're beginning to hit some of those boundaries. The food price index of the UN is about as high as it gets. Growing food is not getting easier. Climate change is coming with heavy floods, serious droughts, and higher temperatures. None of these make farming easier. So we're going to live in a world of bottlenecks and shortages and price spikes, and we have to get used to it and learn to manage our way around it. Commodities have a long history of doing quite well when inflation picks up, for obvious reasons. And inflation is quite likely to pick up. Looking out into the future, it is pretty clear that we are running out of labor. Fertility rates have dropped like a stone. China is reeling from the shock of finding that it has 10.8 million babies last year. It's only the other year, 7 or 8 years ago, it had 20. This means absolute certainty that the cohorts of 20-year-olds coming into the workforce will be smaller going forward. Everywhere in the developed world, we're below replacement in fertility. I think the Fed absolutely does not get the pain that's involved with a bubble breaking. You can see that in the history of the last 50 years. Greenspan encouraged the tech bubble. He bragged about the productivity gains from the internet that would last forever. Actually, productivity has declined slowly but surely since then. When it broke, it caused a lot of pain. Bernanke learned nothing. He encouraged the housing bubble. He denied its existence, even though it was a 3 sigma, 1 in a 100-year event that had never occurred in American history before. And what have we learned? We just went straight back into the game, overstimulating, pushing the rates down and down they have gone for 50 years. So they started at 16% on the long bond, and now the real return you would get is -2. They act as if a low rate is a panacea and comes with no downside. That is clearly nonsense. It's created, I think, the biggest evil in our society, and that is inequality. If you drive up the price of assets systematically, and it's bound to happen if you drive the rates down to negative territory, who do you make money for? You make money for the people with assets. Who owns the assets? The top 1% has 35% of all the assets. The top 10% have practically all the assets. What's the asset ownership of the bottom half? A rounding error, practically none. What you're doing is pushing down on labor, pushing down on the bottom half, with no offset from increasing their assets, since they have none. And you're making the top 1% ineffably rich. And the data bears that out right down to the last 2 years, when the top 0.1% has doubled its wealth during COVID. And the bottom 50%, I can assure you, has not doubled its wealth.